Hi, I'm Louisa Sijabat, a liquidator and bankruptcy trustee. So today's question is a little bit more technical. It is, what happens to Division 7A loans sitting on the balance sheet of a company if that company is to go into liquidation? Now, Division 7A loans are something that tax accountants know a lot about and company directors probably know not enough about, even if they're on their company's balance sheet. These are, in summary, assets, so loans receivable, that is, so accounts receivable, that sit on a company's balance sheet. Now, as to how they arise, that's a question for your tax accountant, but a lot of companies do have them sitting as assets on their balance sheet. Now, in a liquidation, these are assets of the company, and so they're assets that a liquidator has to go and try and recover for the benefit of the creditors of the liquidation as part of the liquidation process. So, some directors feel that just because they're journal entries or things my accountant did or something like that, that they're in some way not real or not consequential if the company was to go into liquidation. But if they're there, it's very important to talk to the liquidator beforehand about them, as well as the accountant. It's important to make sure that they're properly accounted for and that they should be there in the first place. And if they're there, what is the liquidator going to do about them during liquidation? Does the director have funds to pay them? Is there some sort of settlement that could potentially be negotiated? But they are a real item. They can have quite severe consequences in the liquidation sometimes, especially if the numbers are very large. And it is very important to get them sorted out. And my recommendation is to talk to the liquidator before the company goes into liquidation about what the plan is for those. Because if you don't, then the liquidator has to do something with them during the liquidation, and surprises are not a good thing during a liquidation.